Are our banks at risk of collapse? Let's have a look. Hello everyone, Florian.heise here, and welcome to another episode of HeiseSays. Grab your stein of coffee because I want to go through another section of the Financial Stability Review released from the RBA, this time looking at stress testing and our bank resilience here in Australia. Now, the reason I want to look at this, because, well, frankly, it's important, but also remember a few years ago, when there was headlines in the media, RBA predicting 40% housing fall, housing to crash 40%. I remember I did articles on it. I was concerned about it. What it was the RBA testing, modelling and simulating what would happen if we had a 40% house price correction, because they wanted to make sure the banks could handle it. So the media leapt onto it and magnified it, and everyone went crazy about it. And of course, then property shot to the moon. The more cynical among us might suspect that was done with the pure intention of encouraging our political class to stimulate the housing sector, perhaps, and to keep property from correcting. But I'm sure none of us are that cynical. So let's have a look at this, because there's a lot of fear about banks collapsing. I mean, it's happened before. The most recent one, well, the most prominent one I remember here in Australia was when a building society, when Pyramid went under down in Victoria. And you know what they did? They just put a tax on everyone and got their money back. So this is Australia, guys. I'm not concerned about banks collapsing. I'm not concerned about bail-in. I am more concerned about the all money's in clause, or the bank just not liking you or your industry and deciding to screw you over. I think that's much more likely. Go, no, sorry, you're in the construction industry, Florian. We don't want to deal with you anymore. Get rid of your mortgage or your credit cards. We're not in your business anymore. We're out of your sector. Goodbye. You've got 30 days. Good riddance. That can happen. That can definitely happen. There's a high risk of that happening than of the banks bailing in, because we know there's precedent being established here in Australia that our government would throw any future generations under the bus to maintain the status quo. You can't argue with that. And, organizations will use that fear for political attention and to get people motivated. And I understand. But, yeah, I think they'll sacrifice the young before that. So grab a coffee or a stein and let's have a look at this Financial Stability Review, and let's see what it has to say about our banks. So stress testing is a common tool that policymakers use, hang on, I'm going to zoom in, to assess vulnerabilities and resilience of financial systems. The Reserve Bank has recently released details of its top-down bank stress testing model, which primarily focuses on the credit side of bank balance sheets to assess possible implications of various macroeconomic conditions for the banking system. It is designed to be simple and transparent, and to help the Reserve Bank identify which aspects of the macro environment and banking system are driving the results of the test. As was demonstrated early in the pandemic, the adaptability of the model also allows for additional layers of financial stress to be assessed and for a variety of scenarios to be run quickly. This top-down modelling approach complements the bottom-up stress testing undertaken by the Australian Prudential Regulation Authority that uses results from individual banks to assess the impact of a particular scenario on bank balance sheets. There you go. I mean, we're not dealing with a market that isn't highly regulated, everyone. And here's the thing, this all drives up costs too. You got to remember that. Stress testing shows the effects of macroeconomic scenarios for bank capital ratios. The Reserve Bank's stress testing model translates a macroeconomic scenario into implications for bank capital ratios through a series of decision rules and accounting identities. The model uses the same set of equations for each of the 9 largest banks in Australia, and the scenarios are based on predictions of 4 key macroeconomic variables: GDP growth, the unemployment rate, housing prices, and commercial property prices. The main way these variables affect banks' balance sheets is through their effect on credit losses, which ultimately feed through to bank capital ratios. For example, in a scenario where macroeconomic conditions deteriorate, say the unemployment rate increases and housing prices decline, there is an increase in losses on housing credit, which leads to a decrease in bank profits and capital ratios. Figure D.1 presents a simplified diagram of the general model dynamics. Okay, so feed in macroeconomic scenarios. So say you've got unemployment doubles to 7%. Greens introduce new bullshit policy that does something insane in the economy. Then you calculate the credit loss based on that scenario. Calculate the profits and dividends. Then you update the capital levels and asset values to reflect profit and losses. Calculate the change in risk weights and investment in new assets, and calculate the updated capital ratios. At a high level, once credit losses are calculated, a series of decision rules, which take into account the size of each bank's profits and the strength of their capital ratio, determine dividend payments and the amount spent on new assets. If banks remain profitable and capital ratios are sufficiently above APRA's regulatory requirements, banks pay out dividends in line with their historic norms. The profits that are not used for dividend payments, along with additional borrowing by the bank, fund new assets. The capital ratio measures the amount of capital that a bank has relative to its total risk-weighted assets. The amount of profits not paid out in dividends results in an increase in bank capital, while the amount spent on new assets increases total assets, which determine total RWAs, risk-weighted assets. The credit losses for each bank are calculated by mapping the macroeconomic scenario to the rate of loan defaults, often referred to as the probability of default, and to the losses that occur when a borrower defaults, known as the loss given default, LGD. PDs, probability of defaults, and loss given defaults are calculated for the different types of loans that banks have on their balance sheet. For example, multiplying the PD and LGD for a portfolio of housing loans, and then multiplying the result by the dollar value of housing loans outstanding gives the dollar value of expected credit losses on housing loans. The two most important types of loans for banks' credit losses are housing and business loans, which together comprise around 80% of bank loans and around 50% of banks' total assets. In the model, mortgage PDs, mortgage probability of default are determined by two variables: the unemployment rate and the loan to value ratio of the mortgage. Oh, so that's interesting, because that could almost be a snowballing effect, guys. I mean, think about it. If the unemployment rate starts ticking up, less and less people are able to meet their mortgage repayments. We've got expectations that 200,000 people or households will default on their mortgages. This is from other RBA information. If they don't make changes, I'm confident the majority will, but ABC will find those that don't, and they will sing it to the moon how it's someone else's responsibility. But growing unemployment, housing prices decrease, LVRs get worse. Yeah, you know what's going to happen. PDs will go up. This is consistent with a large body of economic literature in both Australia and overseas that suggests an increase in the unemployment rate and higher LVR loans are key drivers of housing defaults. I wonder if that takes into account the fact that we've got a government that's willing to lend on 2% or guarantee 2% home loan, 2% deposit home loans. LGDs for housing loans are driven by changes in housing prices in a given scenario, as the property is used as collateral for the loan, and the current LVR of the mortgage. For business loans, changes in GDP growth affect the profitability of businesses and their ability to cover debt payments. If a firm's ability to cover debt payments falls to a sufficiently low level, it is assumed to default. Similarly to housing loans, changes in property prices affect the LGDs of business loans by changing the values of collateral that secure these loans. Interest rates do not have a direct impact on credit losses in the model. Rather, the effect is indirect. This is so the model can focus on the effects of the macroeconomic environment on the bank balance sheet outside of the effects of monetary easing that are likely to occur during economic downturns. During the COVID-19 pandemic, stress testing was used to assess bank resilience in a highly uncertain environment. At the onset of the COVID-19 pandemic, there was an unusually high degree of uncertainty about the economic outlook and the resilience of banks in Australia. The Reserve Bank used stress testing to assess possible implications for the banking system of the pandemic and associated restrictions. The Reserve Bank simulated a variety of macroeconomic scenarios, including those based on the downside scenarios published in the Statement on Monetary Policy, to assess implications for banks' capital ratios and banks' ability to continue to extend credit to the economy. This analysis helped to inform the Reserve Bank's understanding of whether banks were appropriately capitalized to withstand the effects of the health crisis or whether additional capital raising was needed. These results also provided a useful complement to stress testing undertaken by APRA, allowing for coordinated analysis across the agencies on the Council of Financial Regulators. An important feature of the stress testing model approach was its ability to perform sensitivity analysis on the banking system. For example, stress testing helped the Reserve Bank explore how credit losses could evolve with worse economic conditions, how expected credit losses and the depletion of bank capital differed depending on whether a recession was short and sharp or prolonged, whether capital levels were sufficient to support continued lending growth, or could act to amplify the shock. Such analyses were important for understanding non-linearities in the banking system, where credit losses increased at a faster rate as the economy deteriorates further. The model was also applied to smaller banks, which were not formally part of the model, to examine their potential losses by using estimates of credit loss rates. Another way the stress testing model was used during the pandemic was to assess how severe economic conditions needed to be for bank capital ratios to breach key thresholds. These reverse stress tests can be especially useful in situations of heightened uncertainty. For example, in a reverse stress test presented in the October 2020 Financial Stability Review, it was found that economic conditions would need to be materially worse than the bank's downside forecasts at the time, and not dissimilar to the Great Depression, for a major bank to breach a common equity tier 1 capital ratio threshold of 6%. There you go. So, yeah, we weren't at risk, or the banks weren't at risk to breaching this capital ratio. It can all go out the window if there's a bank run, though, can't it? So banks are resilient to materially higher interest rates and inflation. In response to high inflation, the Reserve Bank has increased the cash rate target by a total of 250 basis points since May 2022. And we'll bring that up here to show you. There you go, guys. That's a huge, very steep climb. The delta is huge over the period. Market pricing implies the cash rate is expected to increase further. Higher inflation and higher interest rates could lead to larger credit losses despite continued, albeit slower, economic growth. The stress testing model can provide insight into the magnitude of potential credit losses and how important they could be for the capital positions of large and mid-sized banks. The model applies two principal stresses to examine the resilience of the banking system to higher inflation and interest rates. 1. Higher inflation and higher interest rates on mortgages squeeze households' real income, making it more difficult to service debt, which could lead to more defaults and larger credit losses for banks. Similarly, and a whole lot of social issues as well. Similarly, higher input costs and higher interest rates passed on to business loans can make it more difficult for businesses to service their debts, potentially leading to higher default rates. We've got another chapter there. We'll look at that one in another episode. 2. Higher interest rates typically reduce the prices of housing and commercial property that are held as collateral by banks against their loans, which increase LGDs as well as PDs on loans. Based on these avenues of stress, two scenarios are used to analyze the potential impact of higher interest rates on banking capital. The baseline scenario. The cash rate increases broadly in line with current market pricing, peaking at around 3.5%. GDP growth slows as higher interest rates weigh on spending, and the unemployment rate is assumed to increase slightly but remain low by historical standards. Property prices, both housing and commercial, are assumed to fall by 10% from peak to trough. Okay, so this is the baseline scenario. I'm assuming that's another term for central scenario, the baseline. So 10% fall, GDP slowing, cash rate predicted to increase to 3.5%. Yeah, I could see that happening. Could you see that going on next year, guys? The severe scenario, the scary one. Market-based interest rates increase by an additional 300 basis points than in the baseline scenario. Okay, so that's 6.5%. 6.5% cash rate, guys. And you know what? What are we sitting at now? What's the hang on. What are we at now? We'll go RBA. We're 2.6% cash rate. Let's just jump CBA. I mean, there we go. We've got 4 to 6%, or 4 to 5%, 5.8% ANZ. You've got 6.8 to 7%. So let's say we increase this by, what are we going? By 4.5%, because we're going 300 above the other one. D35 plus 4.5%. So it's going to do there you go. So you're looking at interest rates in the severe scenario of over 10%. At least if we're just doing simple addition. That's insane. But there you have it, guys. I think I might do another video on that topic by itself. What would, worst case scenarios, could you handle 11% interest? I mean, we're here. Shit, I'm going to be scared to do this. 11.0. Okay? I haven't pressed enter. I'm going to take a swig of my coffee before I do this. So, in this insane, let's hope it's a fantasy scenario, if you're on a 1.99%, and I'm putting that in there because that's what a lot of people, and myself included, fixed in. Fortunately, I don't live in Sydney, so I don't have an insane mortgage. But if you're going off that to what one do we pick? I don't know, ANZ, residential investment. Oh, okay, that's too high. Let's do, what do we want? Variable interest only. Oh shit, that's even high too. Let's just make it, 11%'s not that far off. You're looking at a 158% increase in your mortgage repayments. Okay, let's hope that doesn't happen. I mean, if you're paying 2.9 now, let's do a normal mortgage. So you're paying $2,000, you're going up to 5. This is the severe scenario. Okay, an additional 300 basis points on top of the baseline, which is at 3.5. And we're about 2.6 now, so that's roughly 4.5 above where we are now. So I've just added 4.5% to these rates. And we're looking at this. I'm sure, this is the severe scenario. I'm sure it's not going to happen. But, hey, let's look at what they're predicting here. The severe scenario where we're all screwed. Oh, shit, would you hate to be someone in Sydney or one of those people that got those 2% mortgages? 2% government, 2% deposit, and the government backed you. There'll be blood in the streets. People would be calling for the bloody head of the Reserve Bank if we had this scenario. So, and I'm not advocating for violence. Market-based interest rates increased by an additional 300 basis points than in the baseline scenario. This scenario assumes the economy deteriorates substantially. The level of GDP falls by 4% and the unemployment rate increases to around 11% over about 3 years. Property prices fall by 30%, reflecting the larger increase in interest rates and the more severe decline in economic activities. The bank's net interest margins are assumed to narrow by 50 basis points, reflecting an additional increase in the cost of funds for banks that is not passed on to borrowers. The severe economic scenario does not allow for an offsetting policy response by the Reserve Bank. This assumption helps to assess whether banks are able to withstand severe shocks without policy support and also compensates for aspects of banks' balance sheets that are not captured in the model, particularly the credit side of balance sheets. Since inflation and interest rates do not directly feed into the stress testing model, credit losses on housing loans are estimated using the impact on borrowers' incomes and interest payments from higher inflation and interest rates, based on data from the Reserve Bank securitization dataset. This dataset provides loan-level characterization of housing loans, such as incomes of borrowers and the value of the underlying collateral behind these loans as originated. Defaults on housing loans are estimated by adjusting loan repayments with the assumed path of interest rates, adjusting incomes at origination with past and forecast wages growth, and adjusting household expenses to grow in line with forecast inflation. Adjusting the level of collateral at origination by past movements in housing prices and then the assumed fall in housing prices provides estimates of housing losses for those borrowers that default. Losses on business loans are assumed to be proportional to losses on housing loans. This proportion is determined by the average relative profile of housing and businesses' non-performing loans since 2004 and scaled by the size of the bank's business exposures. In the baseline scenario, the expected direct credit losses on housing loans from the effects of higher interest rates and inflation are around $9 billion. This is the baseline, the normal one, not the one that's got me worried. These losses are equivalent to around 4% of the around $240 billion in CET1 capital currently on bank balance sheets and occur before taking into account profits generated by banks over that period. The model's decision rules dictate that banks would raise provisions in anticipation of future expected losses on housing loans. If the effects from slower economic growth and losses are accurate directly from that occur directly from higher interest rates and inflation are aggregated, the combined credit losses and provision of housing loans lead to a reduction in the aggregated capital ratio of around 50 basis points. The equivalent impact on business loans leads to a further decline in the capital ratio of around 40 basis points. However, the total impact on the CET1 ratio is smaller at around 85 basis points. The total impact includes offsetting increases in the CET1 ratio from the profits that banks continue to generate from their portfolio of loans throughout the scenario. This is graph D1. Overall, in the baseline scenario, the aggregate bank CET1 capital ratio remains well above minimum requirements. So in the baseline scenario, here's the income, here's credit losses, and here's other, and there's the end. So they're still well above the baseline scenario, guys. And this is GDP growth and unemployment rate fall follow consensus forecasts. The cash rate follows a path broadly in line with market expectations, and property prices fall 10%. 10%. Next, let's look at what happened to the bank. Banks if it becomes a shit show. So, the severe scenario has an additional increase of interest rates of 300 basis points from the baseline scenario. The expected direct credit losses attributed to higher interest rates and inflation on housing loans in this scenario is around $24 billion. These direct losses amount to around 10% of bank CET1 capital. However, this is before taking into account additional losses from the deterioration in the economic environment. In this case, total losses and associated provisions on housing and business loans reduces the aggregate CET1 ratio by 270 basis points. The overall reduction in the aggregate CET1 ratio is 345 basis points, reflecting credit losses from housing and business loans as well as other credit portfolios and from an increase in risk weights. In this scenario, despite the significant decline, bank capital levels remain well above regulatory minimums, although some banks do breach their regulatory buffers. So there you go. Current base. So here's the severe one, guys. Look at that. In both scenarios, banks are resilient to estimated additional credit losses that occur from the effects of higher inflation and interest rates. The losses on housing and business loans contribute to declines in banks' capital ratios, but the high initial levels of capital and continued income generated on banks' loan portfolios means that aggregate capital levels still remain well above the minimum requirements. We can see that here. GDP falls 4%, unemployment rate rises to 11%, property prices fall 30%, and interest rates rise an additional 300 points, with an additional 50 basis points reduction in NIMs. Let's just drink a stein to that one, guys. So this will be the impact when people are predicting huge property price falls. So these stress testing results are subject to considerable uncertainty. Well, naturally they are. This is especially true in the severe scenario where such a sharp increase in interest rates has not recently been experienced in Australia. In addition, there could be important non-linearities and feedback mechanisms that are not captured in these scenarios, such as a case where credit losses result in banks pulling back on their lending, which leads to a further deterioration in the economic environment and further increases in credit losses. The nature of the shock will also have a bearing on bank resilience. For instance, banks are assumed to have continued access to funding markets. The price of these funds increases, but market functioning remains orderly. The above analysis focuses on credit risks because this is likely to be the most important variable for bank resilience in Australia. However, there are some other variables that could reduce capital ratios. For example, high interest rates could lead to some losses on banks' trading and banking books. Indeed, the major banks have already experienced declines in their CET1 ratios from higher RWAs related to increases in interest rate risk on their banking book. Conversely, the scenario does not account for some possible benefits accruing to banks from higher interest rates. For example, market analysts expect rising interest rates to result in wider NIMs for banks. While it is possible that NIMs widen in response to higher interest rates, it does not necessarily follow that higher interest rates will lead to an increase in bank profitability because it depends on the pace of loan growth, the extent of competition in funding, and lending markets and asset quality. So there we go, everyone. So let's just have a look at this one while I have a shot of coffee. So let's have a bit of a talk. So according to this, even in the severe scenario where we've got a 158% increase in mortgage repayments for people who smartly locked in early, the banks are still going to be resilient. The risk of them collapsing isn't there. The risk of them breaching for an extended period, their requirements are not there. The banks will be okay at both levels. So we shouldn't be worried about them collapsing. But we should prepare for, at least the baseline scenario. Do you think the severe scenario will occur? Let me know your thoughts in the comments below. What would that do to the culture of Australia? We're so obsessed with property. It'd destroy a generation. How many people do you think could afford a huge increase in their mortgage repayments of that much? And would, if we have it while Labor's in power, will they ever get in again? It'll be another, 3 decades before we do? Probably completely nothing to do with them, honestly. Anyway, guys, I thought this was important to have a look at, to just compare and contrast the two scenarios. This is what's happened with the Reserve Bank saying interest rates won't increase until 2024. The media just jumps on one thing and just plays it up. And then every man and his dog just listens to that and they believe that. And then all of a sudden rates are shooting up. I mean, shit, what are they going to think if we go another 300 basis points from the baseline scenario? What's that, 6.5%? What will people think then? So guys, let me know, which one do you think is more likely, the baseline or the severe scenario? Take care, guys. Have a great day. And if you want to support the channel, there are a few ways you can, either on HeiseBim or HeiseSays International for other content I create. If you want to support us financially, you can via YouTube or Patreon, using our referral links at Amazon, eBay, Independent Reserve, or AussieBroadband. You can buy our pocket squares or call us if you need an architect. Take care, everyone. I'm trying a different approach now. I'm doing more long-form, detailed videos going through specific things that I think we need to be aware of, that the media will just kind of wash over. So we'll only have 1 or 2 videos a day for the time being. Take care, and I'll see you tomorrow. Bye for now.